Welcome, everyone. I'm Richard Dale, representing Sydney Angels. Sydney Angels is an angel investment group with 100 angel investor members who form teams to invest their own money and time in startups that they select. Sydney Angels was established back in 2008, so this is our 15th year of operation. So today I'm going to explain term sheets, an important step in our investment process, as it is for most professional investors. We run this session for several years as an interactive workshop, originally in the real with maybe somewhere between 20 and 50 people in a room at lunchtimes. Today we're doing it online, which means it's going to be more about me asking and answering rhetorical questions than us interacting in person. But please do post your questions and share your thoughts on the chat. Others will benefit from your questions and comments. I may not have time to answer your questions directly as they occur, but I will try to keep an eye on them and adjust the things I spend time on as we go. You can use the raise hand reactions button in Zoom if you're familiar with term sheets. That will help me pitch at the right level in this session, because I don't know who you are, unfortunately. So if you could all maybe just use the raise hand button if you've dealt with term sheets before. Just give me a sense of what the level of knowledge is out there. Okay. Sort of looks like maybe a third of you, perhaps. Okay. And Damien Chan, I can see you there on the call. I know you've dealt with term sheets before. Put your hand up. Okay, that's good. Thank you. So as you're a mixed group, some of the things I'm going to say might be too basic for you. Some of them might be too advanced for you. So I'll try to strike a happy medium between those two things. Okay. Yeah, and look, these slides, we've done this in public for quite a few years with Spark Festival as well. So these slides are publicly available on our Sydney Angels LinkedIn page. So I've reviewed the presentation from the one I gave last year during Spark Festival, and the slides are essentially the same. The commentary that I make during the preso will be obviously a bit different, perhaps, but you can go there anytime to the Sydney Angels company page on LinkedIn and just search through the historical posts, and you can find this presentation as well as a video of when I was doing it last time. We will be in due course updating the post with the slides I used today and a video from today, but you can go there now and get last year's version if you need to. Okay, so let's get going. So a term sheet is really just a memo, a few pages describing the key points of a deal. It's meant to be a plain language description of the deal, and the deal being investing cash for shares or other types of securities in the startup. And it just really captures those key terms. Who are the parties to the deal, what are the key terms and the next steps. The usefulness of a term sheet is all to do with having a negotiation and documenting it and moving things forward on the basis of agreed terms. Term sheets are usually non-binding. They can be made binding, but that's not usual. And they're usually drafted without lawyers, but it's usually based on a template which is probably originally written by a lawyer. It saves time and expense for both the founders of a startup as well as for the investors. And when complete and agreed, it serves as a very useful detailed briefing to be given to lawyers to create the binding transaction documents for a deal. So the idea is don't get the lawyers involved until you know what the deal is, and that requires something like a term sheet to document what the deal is. What you can see in front of you is the first 2 pages of the template, ordinary shares template. Well, the first 2 pages of the ordinary shares template term sheet, which is used by Sydney Angels. We're usually investing for ordinary shares in most startups that we see because there's usually there often hasn't been previous investors, or if there have been previous investors, they're also on ordinary shares. So the ordinary shares template is the one that we use most frequently. And as you can see, there's some headings in the template, and I'll explain what some of these terms mean during the course of this workshop, because that's the whole point of it. It's about demystifying what term sheets are and what do the words and what does the language mean, and why they're important. The idea of using a template, of course, is if you're on the investor side, it means you're consistent from one deal to the next in terms of the kinds of things you'd look for as terms in a deal. If you're a founder, if you encounter term sheets, increasingly they should look similar, because most investors are using something that is basically similar to some of the public domain templates, such as the ones provided by the Australian Investment Council. Our term sheet's essentially like that, except it's customized for our investment process. So that's one of the reasons why you'll encounter different flavors of term sheets, is because different investors have different processes and they want to include some of those processes in their term sheets. However, the key terms are usually pretty much the same. So who needs to know about term sheets? Well, pretty much anyone who's involved in any aspect of a deal where a startup is trying to raise money. Obviously, the founders need to know about term sheets, but term sheets aren't just used by startups; they're also used by established businesses and other types of deals. Today, we're just going to be talking about term sheets as they relate to startup investing. The other parties, obviously, to a deal are going to be the investors that you're talking to as a founder, or as an advisor, or as a mentor, or as a consultant, and also lawyers. Lawyers need to know about term sheets because they will often receive a term sheet as the briefing for creating the transaction documents for a deal, or they may be asked to review a term sheet to see if it's fair and reasonable from a legal perspective. So whenever you attend a webinar or seminar like this, you should always ask yourself, does the person giving this webinar know anything about term sheets? I've been involved with startup and VC investing for a long time, and I've seen literally hundreds of term sheets. This gives me a sense of what is normal, fair and reasonable for a given situation, and also the trends in the market and so forth. But when you encounter a term sheet for the first time, how do you know what's fair and reasonable? So one of the reasons for this workshop is to try to share some of that knowledge. Investors often have more experience with deals and term sheets than founders. So founders rightly worry that they might be taken advantage of because they're relatively inexperienced or less knowledgeable about term sheets and all of what the terms mean and the various ways that they relate to each other. Once again, I'll try to cover off some of those issues in this workshop, so to level people up. The key thing I want to convey is that don't get too fixated on the terminology. Try to stay focused on the key commercial points of the deal, and don't jump straight away to suspicion when you encounter investors and term sheets that seem to be asking for terms that sound demanding or onerous, when in fact they're probably just quite normal, and it's just the language that's unfamiliar to you. So I'm going to start some rhetorical questions now. And the first question, which is controversial, is why bother with term sheets at all? They're a non-binding document that doesn't commit anyone to do anything. Why not just go straight to binding subscription and shareholder agreements? And aren't safe notes easier and more modern? Well, they're all good questions, and I'll try to cover off those questions, during this workshop. Let me turn to some more rhetorical questions. So, how should term sheets be used? Oh, it jumped ahead of itself. Hang on, let me go back. How should term sheets be used? Should you offer investors your term sheet or ask them for theirs? At what stage in the discussions should you expect that to happen, or should you make that happen? What's fair to ask for? Which terms should you resist, and which terms should you insist on? And how can the process be made a positive and constructive experience for everyone? That last point is my key objective for this workshop, because a negotiation is inevitable, but it can be a positive and constructive experience. It should not necessarily become adversarial. So there are avoidable problems that can arise, and this is why we want to demystify term sheets. So you can't escape the essential fact that you will be going into a negotiation, but let's try to get rid of the avoidable problems. I think you can all read the points on the slide, but some of these problems just arise because people have different interpretations of what the terms mean, or they don't understand what the terms mean and then get surprised and suspicious later on. The terms may appear tough or unreasonable, particularly if you don't know where the current benchmarks are for this type of deal, your type of company, this type of investment. And those benchmarks, or those goalposts, move around. And as you would all probably be aware, right now we're in a down cycle in venture capital and startup investing, where things like valuations are becoming lower from their previously quite high levels in 2021, and terms are getting tougher. It's a cycle. For those of us who've been around long enough, we've seen several of these cycles, and we're now in a down cycle. Hopefully not too deep, hopefully not for too long, but it is a down cycle. And lastly, it is a negotiation, it is a discussion. So communication is very important. And really, in most cases, the onus for good communication should really sit with the investors, because investors should be more experienced at this. The founders are often novices at this. So I think there is a moral obligation on investors to try to help the founders understand, but recognizing that it's unavoidable that there's a conflict of interest here, because the investors are seeking to buy and the founders are seeking to sell. So buyers can't advise sellers and sellers can't advise buyers. Even so, investors can play a very constructive role in trying to be founder friendly and help the founders. The worst situation you can get in any kind of investment negotiation is an inexperienced founder dealing with an inexperienced investor. This is a recipe for a falling out straight away, or certainly in the future. So it works for both sides to be better educated about both the what term sheets represent, how they can be used, what the terms mean, which terms are appropriate, and also how to conduct a positive, constructive negotiation when you're ready to start the negotiation. So I'm going to do a quiz, but because it's an online meeting and we haven't got a lot of time, I'm going to just ask the question and then answer it rhetorically for you, but hopefully this will work for you. So the first question I'm going to ask is about pre-money valuation. There's 4 options there for a definition of pre-money valuation. There's more than 4 ways of describing it, but there's 4 there. And the question is, which is the the right answer or the best answer. And it's a bit of a trick question because arguably they're all correct definitions. But the first one, A, is the simplest and best answer. It's pre-money valuation is simply the number of shares, or number of ordinary shares, or ordinary shares that would exist if all other securities were converted to ordinary shares, outstanding before the investment multiplied by the agreed share price. That's what pre-money valuation is in its simplest possible definition. Now, in this workshop, I know there's probably going to be a lot of interest and curiosity around valuation per se. I'm not going to spend much time on valuation because it's a big topic in its own right. My colleague at Sydney Angels, Adrian Bunter, is running another workshop similar to this, specifically on valuation and how to value a startup. So if you want to get into the valuation topic, I recommend you look for that workshop. Okay, let's jump to another question. How is fully diluted pre-money valuation different, and why use it? Well, the answer is that the fully diluted pre-money valuation is really the effective pre-money valuation as far as the investor is concerned. That's the price they're actually paying for the equity that they get. And what we mean by fully diluted is that any options or convertible notes or safe notes or any other convertible security, as well as the ordinary shares themselves, are all converted to ordinary shares and multiplied by the share price. That gives the fully diluted pre-money valuation. And obviously, because those convertibles, things like C notes and safe notes and options, because those things create more ordinary shares, the fully diluted pre-money valuation is always higher than the simple pre-money valuation, which is just based on the current number of ordinary shares. So as an investor, the thing that I care about is the fully diluted pre-money valuation. So when you're constructing a term sheet or reading a term sheet, look for that word fully diluted to see which type of valuation is being referred to. It makes a big difference, both to the investor as well as to the founders, because it's effectively the sticker price that you're advertising the investment opportunity in your business. Another bit of terminology that you'll encounter in term sheets, as well as in transaction documents and maybe just in conversations, is this phrase on an as converted basis. So what does that mean? Well, it's related to what I just said a moment ago about fully diluted pre-money valuation. On an as converted basis means you just take all of those convertible securities, things like preference shares and C notes, and you convert them on their terms into ordinary shares. Because at the end of the day, what really matters is the total number of ordinary shares and how many each investor holds. That determines their equity, and it determines their voting rights, and so on and so on. So on an as converted basis just means you convert all securities back into ordinary shares at an agreed share price or at an agreed conversion price. What is the conversion price and where is it used? Well, this is an easy one because I've just described what on an as converted basis means. So the conversion price is just the price at which you make the conversion. So if you have a certain preference share or class of preference shares at any given time, it will have a particular conversion price, and that just describes how many ordinary shares effectively you get for one preference share or one C note. So, for example, if a preference share had a face value of $1, and let's say because of, for example, anti-dilution, which I'll talk about in a moment in a future round, that the conversion price might drop to 50 cents, which means that in the future, that preference share would convert into 2 ordinary shares, not 1. It would start off being 1, but it could change in the future, depending on how the conversion price operates under the influence of things like anti-dilution, which is setting up my next rhetorical question. What is anti-dilution protection? Well, very simply, anti-dilution protection is something that investors like to have, because it means that if the company raises money in the future at a valuation below the valuation or below the share price that the investor invested at previously, it means that they get extra shares or entitled to extra shares. And the way that works is that the conversion price adjusts. Now, you only get anti-dilution protection if you have invested in something like preference shares or convertible notes, because those instruments have this ability to change the conversion rate. If you've invested in ordinary shares, you don't have anti-dilution protection. Now, most venture capital funds will request preference shares or insist on them, and certainly that's the norm. For Sydney Angels, because we're investing typically at the first, professional investors after friends and family, it's quite usual not to need preference shares, but certainly when preference shares become part of the deal, there's no point investing for anything other than preference shares, because you never take lower ranking securities in a deal. So you will encounter preference shares if you ever get into an investment discussion with a VC fund that's interested in investing in your company. And if they offer you a term sheet, it will invariably use preference shares. Now, what are the 2 types of preemptive rights investors want to have? Well, first of all, what are preemptive rights? Well, what it basically is first right of refusal. Okay, so let's talk about the 2 types of preemptive rights. The first one is tag-along rights, and the idea of tag-along rights is that it's the ability for minority shareholders in the company to tag along should one of the shareholders, usually the founders, start selling their shares to someone who wants to buy effective control of the company. So it means that the minority shareholders don't get stuck in a company which is where the founders are basically selling out. So it's tag-along rights are there to protect the minority investor. The other type of, hang on, I've gone too far. I've jumped ahead of myself. Hold on. Yes, I jumped to tag-along rights when I was still stuck on preemptive rights. Sorry. So the 2 types of preemptive rights are when the company is issuing new shares, existing shareholders want to have the right to buy some of those shares so they can maintain their position in the cap table, maintain their equity percentage. So it means they get first right of refusal on those new shares. The other type of preemptive right is that when another shareholder is selling their shares, they first have to offer their shares to existing shareholders so that they can keep the shareholder group, restrict the shareholder group to, for example, desirable shareholders, keep it in the family, or just to allow existing shareholders the right to increase their position if they would like to. So those are 2 types of preemptive rights that are important, and are pretty much you'll pretty much see those in every deal. Those 2 preemptive rights on new issues and on sales of existing shares. Now, I'll now get back to what I was talking about a moment ago. Tag-along rights. Tag-along rights are protect the minority shareholder. I've just explained what they are. The other type of right, which is, I guess, the inverse of tag-along rights, is drag-along rights. And the idea of drag-along rights is to protect the majority of the shareholders if a great offer was made for the company to acquire the company. So to protect them so that they can accept that deal and sell the whole company to that acquirer without being held up by an obstructive minority. So drag-along rights mean that the majority can force the minority to sell into the deal on the same terms. So that's often a feature also of term sheets. Information rights. These are really important, and particularly to investors, because remember, investors aren't generally in the business. They don't necessarily know what's going on. So information rights is the information that the company, that the founders, that the board is obliged to provide to the investors on an ongoing basis. These might be things like monthly or quarterly reports or dashboards, is what, in addition to annual financial accounts and so on. So information rights are something that any professional investor is going to insist on. What the appropriate level and complexity of those reports are will depend on the company, the stage it's at, and also what the investors want. At Sydney Angels, we try to keep it simple. We like dashboard type reports on a monthly basis. The idea is this would be a scorecard of metrics that matter that would be useful for both managing the business as well as for keeping your shareholders informed as to what's going on, and also give them opportunity to help if they can. Okay. What are reserved or critical business matters, and what rights do investors want? Well, in most cases, actually all cases when it comes to venture investment and angel investment, investors are always going to be a minority investor, a minority shareholder. Even if they have a board seat, they're going to be in the minority on the board. So usually, professional investors require some set of vetoes or rights to approve certain critical decisions. And these are things like fundamental things like strategy, business plan, selling core assets, hiring a CEO, and other big things like that, that if those changes are made, it could literally make or break the business. So investors, when they ask for these rights, they can't make these things happen. They just want the right to be consulted and the right to approve these big changes if it's something that the board, which is usually controlled by the founders, want to do these things. Okay, what is founder vesting and why is it a good idea? In a nutshell, founder vesting means that founders, from the day that they receive the investment in the company, some proportion, potentially all of their shares, but some proportion of their shares effectively become restricted, so that in a way they kind of earn their shares back over a period, typically 3 to 4 years, provided they stay in the business and perform adequately during the vesting period. And the reason for this is that investors are investing today. The founders may have been in the business for several years. The investors are investing because they expect the founders to continue in the business and push the business forward. They don't want the founders putting their feet up and leaving it to the investors to then find new management for the business. So the founder vesting is really there as a penalty should founders decide to freeload or leave. So that's protecting the investors, but actually, if you're a founder with a co-founder or several co-founders, it also protects you, because it means that if one of your co-founders puts their feet up or leaves, leaving everything to you to fix or do, then effectively they lose their shares, which once again creates an incentive to stay, because investing and building a startup is a long-term commitment. It's not something that you can expect to earn easy money from. So founder vesting aligns incentives for the long term. It's good for investors and it's usually good for founders who have co-founders. Okay, so that was a list of common terms that you'll encounter in pretty much any term sheet you see for startup type investment. The details of those terms, how they're specifically implemented, obviously will vary, but they're very common to see in term sheets in startup and startup investments, whether you're taking investment from VC funds, angel investors, any professional investor will have usually some or most of these terms in their term sheet, or language like this in their term sheet. I'm just going to do a quick advertisement for Sydney Angels now, just to put all of this in context for you. So as I said at the beginning, Sydney Angels is an angel investor membership organisation established in 2008. So Sydney Angels itself is not an investor. It's like a club that has members, has an elected management committee, and it runs processes which help its members identify deals that they would like to consider for investment, to form syndicates, and to carry out appropriate due diligence on those deals, and then to invest in those deals. So Sydney Angels itself is not the investor; its members are, and they invest in teams or syndicates. Sydney Angels is really there as the home for founders to apply, for people interested in becoming angel investors to apply to become members. And Sydney Angels facilitates a process that we've been running successfully for a long time now. So it's a very mature process with a lot of rigor and experience built into it. In terms of statistics, about every 6 months, and this is back, these charts relate to the last update that was done in March. Every 6 months, we review our portfolio and our pipeline and deals and produce some statistics for our own benefit, as well as to share publicly in sessions like this and through our Sydney Angels LinkedIn page. So you can see on the left how we've grown over the years with both membership and portfolio companies or investees. So as at March, there was 85. There's been a couple more since then. It's my job to redo these updates. I'm due to do the one for up to September this year. I just haven't done it yet. So we're looking at March data here. So we've got around 100 members currently, and 85 companies in the portfolio. Those numbers will obviously increase a little bit in the September update when it's available. And on the right-hand side of the chart, right side of the slide, sorry, you can see the total amount of dollars in millions that have been invested in Sydney Angels in companies each year. So these things are additive. And what you can see there is really the much larger volumes of money that get invested in these companies in their later stages. The small little blue bits at the bottom is where Sydney Angels members and Sydney Angels sidecar funds have been investing in those first rounds, those early rounds. But what happens is those, the successful companies go on to raise much more money in later rounds. And if you're an early stage investor, that's great, because it means that some of the companies you've invested in those early stages are now being powered forward by much larger investments in later rounds. And in addition to investment, also some companies, particularly the life sciences biotech companies, are usually able to get quite substantial amounts of grant funding, which is obviously non-dilutive capital, as well as taking advantage of the research and development tax incentive. So that's what the little orange bits in that chart represent. Here's the logo chart. You've got to have a logo chart in every preso. These logos represent those 85 startups I just mentioned. There's a couple more logos to go on that chart as soon as we update these slides. We're agnostic about business model and industry. We assess every deal on its merits, and our mix of investments tends to reflect the mix of deals that we see. So the pie chart on the left just segments investments by business model. So SaaS, business SaaS is the largest component, but by no means is it the only component. We invest in every type of business model or have invested in every type of business model you can imagine, because remember, we look at every deal on its merits, everything from SaaS business through to drug development companies. And if you look at the industries that those investees represent, it's a broad range. So unlike a VC fund that might have a certain strategy to focus on only, say, one sector or one business model or one industry, or a limited number of those, we don't pretend that we can predict the future. We look at every deal on its merits, hence the diversity of invested deals. It also reflects the fact that with 100 members and a syndicate and a team or syndication model inside Sydney Angels, you've got 100 people with diverse interests. So quite often the syndicate can form around a company because it only needs, say, 10 to 15 members who have interest in that particular type of business to allow an investment to happen. And our investment process runs on cycles. We have 6 cycles a year, and we run a funnel process. So any company can apply, any startup can apply any time to the Sydney Angels website. The committee reviews applications on a weekly basis. Every 6 to 8 weeks, we then collate the best of what we've got that cycle, invite the best 6 to pitch at a deal screening meeting. We then pick the best 3 from those 6 through a panel voting process to present at a members meeting, which is to the full membership. And at that stage, typically 2 to 3 will go into syndication process, due diligence, term sheets, and out of that, 1 to 2 will get invested. That's how our cycle works. So, the best 3 make it to the members meeting, the best 7%, and on average, 1 to 2 of those 3 will get invested. So if you get to the members meeting, you've got a pretty good chance of getting invested. Term sheets, back to what this workshop is about. Term sheets sit in the middle of our investment process. So after that members meeting, the syndicates form around the companies that they're interested in, to start the process of getting to know the founders better, getting to understand the business better, identifying the questions they want to drill into in due diligence. And once they've gotten enough validation on some of those issues, that's the time to have the discussion about the terms of the deal. You don't have the discussion until you know enough about the business to think that, yeah, it's as good as I thought it was. You don't want to leave it too late either. You want to make sure that your intent is genuine. That is, you know enough to say, yes, we're interested in investing on these terms, and to have that discussion with the founders. So term sheets sit in the middle of our process. And to make that process go smoothly, of course, we ask our members to use our template term sheets, or to use our template term sheets as a checklist if the founders have presented their own term sheet, or if there's maybe another investor leading the round and they've already got a term sheet in front of the company. So we need to understand what those terms are and whether we like them. Either way, term sheets become the medium by which you can explain the terms of the deal. I said at the beginning that it's not about the term sheet itself, it's about the process, it's about the negotiation. So at that stage in our process, it's about going around in circles a few times with the founders until you've got agreement on the key terms of the deal. And the term sheet, because it's a short document using plain English and some terminology that you've just got to learn, is the way in which you keep track of what are the deal terms. And when you finish that process, which might take a short time or a long time, depending on how controversial things might be, when you've got that process finished, that's when you're in a position to instruct lawyers to draw up transaction documents. You really don't want to be incurring legal expenses until you know that the deal is a deal you want to do. So that's the role of term sheets for us in our process. That's where they sit. Let me talk about now different types of term sheets. At Sydney Angels, we have 3 templates. We have a template for ordinary shares, which is the one we use most often. We also have templates for preference shares and for convertible notes. These different types of securities are suited to different situations. For most situations, for the deals that Sydney Angels looks at, ordinary shares are fine. There are, of course, circumstances where they're not fine and you need to use something else. And this traffic light board here just gives you some examples of situations where it's unlikely that an investor would accept ordinary shares because of what's going on with the company at that point in time. So a classic example is where you have been talking to, say, maybe a seed or pre-seed fund. They've offered you a term sheet, and it's invariably going to be for preference shares. But you don't have enough money from them. You need other investors. You've come to Sydney Angels. We're interested in looking at the deal. It's not our term sheet. It's someone else's term sheet. They are insisting on preference shares, so we will insist on the same shares, at least preference shares. We still want to understand the rights in the deal, make sure they're sufficient. But we'd never go into a deal with a lower ranking security or less rights than someone else. Or if there's a previous investor who's sitting there on a convertible note, say, and it's now a new equity round, we'd want to do something about the convertible note, or likewise, we would offer a convertible note to protect ourselves. So generally speaking, investors will always want to have equal or better terms than previous investors or current investors. Let me talk about safe notes. Safe notes have been all the rage for a couple of years now, or several years, during the upcycle in the VC market. And they certainly have their uses. For Sydney Angels, like most professional investors, we prefer priced equity rounds, but safe notes do have a role to play. And let me explain, first of all, what a safe note is, in case anyone doesn't know. The idea of a safe note is that it's a way to avoid really a negotiation, because it says we're going to not try to come up or agree on a valuation. We're just going to say we will issue you shares at some point in the future at a valuation no higher than a cap, and if we'll issue those shares in the future because someone else has agreed a valuation with us. In other words, there's been a price equity round in the future, we just don't know when, and whatever price those future investors have agreed with us, you will get a discount on that price for the money you invested earlier through the safe note. So it's a promise for equity in the future, subject to a cap and a discount. So it's a promise. Unlike a share or convertible note, it doesn't actually convey any rights, and that can be a problem for professional investors, and there's ways of dealing with that. But the key thing is the safe note is easy to use. It's easy for the founders to use because you can just sign investors up in a sequence. The investors don't really need to coordinate. You can just keep signing them up. You can build a book with a safe note. It's great for book building. It really suits a situation where you're raising money from lots of disconnected independent investors, usually individuals, and it's convenient. It avoids a negotiation. It avoids complex legal documentation. It's a standalone document. But some investors that you might want to attract will either not like a safe note, or they'll want the safe note to be strengthened so that they have rights. And there's ways of doing this. So I just want to point out that safe notes, whilst they're very founder friendly, are not always suitable or attractive to certain classes of investor. They would usually prefer, if they're a professional investor, they'd usually prefer something else. But they may go along with the safe note if it's got appropriate strengthening built into it. And the kinds of strengthening I'm talking about there are quasi-information rights and voting rights potentially built into the shareholders agreement, acknowledging the fact that safe note holders exist and have some rights. So a useful tool, but not always the best tool to use, depending on who you're planning to raise money from and what the preferences of investors you prefer to raise money from are. Safe notes are also useful for internal rounds, bridging rounds, which you're seeing a lot of now, where lots of startups who maybe raised money in 2021 or 22 now need to raise more money, and are finding it's hard to achieve the kinds of valuations that achieved previously. And so what they're likely to do is to do an internal safe note round with their existing shareholders. They might use a convertible note rather than a safe note. A convertible note has the same properties as a safe note in terms of not defining a valuation. But a convertible note, unlike a safe note, actually is a very powerful instrument, giving the holder of a C note debt powers over the company, whereas a safe note is much less powerful, although the terms of the investment can be almost identical in terms of cap, discount, and so on. So safe notes, you'll undoubtedly have encountered them or seen them. They are useful. They have a place. They're good for internal rounds. They're less good for professional investors for raising new money, although professional investors may go along with them depending on how much or how badly they want to get into a deal. But generally, professional investors prefer priced equity rounds. So the structure of a term sheet and the mechanics of it. This slide, and it's a bit wordy, I apologize for that. And maybe this is one of the slides that you pull out and review later after you've downloaded them from our Sydney Angels LinkedIn page. There's always going to be the core investment proposal, the blue column on the left, which talks about the key terms of the deal. Who's in the deal? Who are the founders? Who are the other investors in the round? Who are the existing security holders? What the cap table is, what the valuation is, how much money is to be invested. These are the key terms, right? And any special timing or conditions on the investment. It's quite common for term sheets to include, for example, a minimum round size or condition precedents where the investors agree to invest provided certain things happen. Like, for example, you raise at least $1 million or $500,000 or whatever the minimum is from them plus other investors, because it's quite foolish to invest in a company that doesn't raise enough money to execute its business plan. So it's quite common to have those kinds of conditions precedent in the deal. But then there's a whole bunch of other things, those other columns to the right, which you'll also find in term sheets to varying degrees, which are to do with some of the things we spoke about earlier, preemptive rights, information rights, board seats, board observer rights, rights to approve critical business matters or veto certain types of decision, and some inevitable, legal boilerplate type stuff. You'll find those in term sheets too. So some term sheets are short, some term sheets are longer. The Sydney Angels template is kind of like in the middle. It's what I call a full specification term sheet. It includes bullet points or headings for all of the things on this slide in a brief way, but at least that way you know that these things are in, these things are not in, and when you get the full detailed transaction documents back from your lawyer, there won't be any surprises. Very short term sheets that have maybe just very summary points, very high level points, sometimes lead to surprises later on when founders encounter the full transaction documents and discover, oh, wow, that one sentence translates into 10 pages of onerous legal terms. We try to avoid surprises by declaring at least what's going to be in the documents if we end up proceeding to investment. Now, of those rights that we've been speaking about, some of them are no-brainers. They're good for the founders. They're important to the investors. The green things on this chart. Some things can be seen as being win-lose, not necessarily, but they can be seen as win-lose. And the orange things on this chart tend to be the things where there's negotiation. Obviously, valuation is one of those, but it can also be negotiation around things like what level of vetoes the investors get, or what level of vetoes the founders are willing to tolerate. Because they can, if they're too tight, too extensive, effectively it equals micromanagement, and that's something to be avoided. Investors aren't running the business; the founders are. So you have to strike a happy medium on all of these things. I've left something in the bottom left-hand corner there of forcing an exit. Now, when I first got involved in VC back in 1999, forcing an exit was a regular, very important term in every term sheet, every deal that the VC funds I was involved in had. And this was the right for the minority investor basically to force the founders to sell the company because the investor wanted the money back. You don't tend to see that anymore. It is a feature in some private equity deals, for example. It tends not to be a feature anymore in VC deals, although I suspect there's quite a few VCs, late-stage VC funds who invested in late-stage deals at very high valuations that might be wishing they had such a right to force an exit, but now they're going to have to wait until more opportune times and for the market to allow them to get an exit. So you won't see a force an exit term these days, I believe, in any startup term sheet. You might see it in very late stage term sheets. I think I've got about five minutes left. I did start late at 5 minutes past to allow everyone to turn up. So I'm going to go for somewhere between 5 and 10 minutes from here. So what I'd like to do is maybe just walk through a scenario to try to bring some of these things to life. Because remember, a term sheet is just a way of documenting a negotiation. The object is not the document. The object is a successful negotiation. Term sheet is just a way of recording it. So let's put this into reality by looking at a scenario. So let's define the scenario. So here, we've got a situation where a Sydney syndicate's done enough DD on a company and got to know the founders sufficiently that they would like to invest. They've put a term sheet to the founders, and the terms are slightly different to what the founders pitched or asking for. And it's complicated by the fact that the founders are also talking to another external co-investor who's willing to put up about 40% of the money that the founders are seeking to raise. And they're being more generous with their terms. Essentially, they're accepting what the founders have asked for. And there's nothing wrong with that, but it means that clearly for this round to close, if Sydney Angels and this external co-investor are the only investors the founders have achieved progress with, then to close this deal, there's going to have to be some give and take. So from the investors' perspective, from the syndicate's perspective, their objectives are to explain their proposed terms to the founders and hopefully get them to understand and to even like the proposal. Also to persuade the external co-investors of the benefits of solidarity and investing on the same terms. And importantly, to make the whole process efficient and a pleasant experience or productive or constructive experience for everyone involved. So those are the syndicate's objectives. So how do we proceed? Well, if you look at this scenario, this fictitious scenario, which is based on reality, you've got a situation where there's differences between what the founders have asked for and what the Sydney Angels Syndicate are willing to offer. The differences are not that big, but there are differences. So in terms of the money, the founders wanted to raise $500,000 for ordinary shares. Syndicate agrees with that. $500,000 is the right amount, but they want to do it in two tranches, $250K up front and another $250K subject to certain milestones being achieved. That's a way of reducing risk where something is very uncertain and you want to have further proof. So instead of losing all of your money, you're only at risk of losing half of your money if that thing doesn't happen. On the valuation, the founders pitch their offer as a pre-money of $2.5 million. And the CDL syndicate has asked for $2 million on a fully diluted basis. Remember, I spoke about the difference between fully diluted valuation and just a simple valuation where you're not taking into account convertible securities and options. So there's the biggest gap here is going to be valuation. Using the funds, the founders did the old pie chart trick of saying we're going to spend 40% on this and 30% on marketing and 20% on overheads. Whereas the investor syndicate saying, actually, in the first tranche, we want the first tranche of money to be spent on certain things and the second tranche to be spent on different things. The idea here being that defer spending on the marketing until you're certain you've actually figured out pricing, for example. So it's a way of controlling expenditure based around how certain we are about whether the plan is going to work. Incentives, both sides agree there should be a share option plan for other members of the team. No difference there. Really, founders said share options. The Seniors Member Syndicate was saying employee share scheme, technical differences, but essentially the same thing. A point of controversy here in this particular scenario is that there's an existing C note in the business of 100K repayable over 12 months. Well, sorry, the founders are saying that will be repaid over 12 months. Where's that money going to be coming from? It's going to be coming out of the money that the new investors, either the Senior Syndicate's putting in. We don't like that idea. So what we're saying is, well, if someone's sitting on a C note, have them convert the C note into equity on the same terms as we're getting, and then we're all on the same page. So that might be a sticking point. The board, the differences here are really just in the composition of the board and the fact that the Senior Syndicate would like to have the right to appoint an observer. And this is quite common for us. Sometimes the right to appoint a director isn't something that is ever going to be taken up, but having an observer is very handy. Sometimes we'll have both rights and use one or the other depending on the circumstances. Other times we'll just have the observer right. And lastly, the Sydney Syndicate has included some founder vesting terms, customary terms for protecting minority investors. That's things like the tag along and the drag along. And because this investment was going to have the Sydney Sidecar Fund co-investing with the member syndicate, it'd have to be ESVCLP compliant, which is really not a problem for most startups. So there are some differences there to negotiate around, but the term sheet is really just becomes the way in which that negotiation can be documented as you move from step to step to step. Lastly, let me just mention a couple of things. Cap tables. Cap tables are really important, and including a cap table in a term sheet is an absolutely brilliant way of communicating what the terms of the deal mean in terms of numbers. The pre-money situation and the post-money situation. So if ever you get involved in the term sheet, look for the cap table. And if it's not there, as an investor, insist it is there. And if you're a founder, I strongly recommend you include cap tables in your term sheets because it just makes the whole situation so much clearer to everyone. People might understand the words, but you know what? They always understand the numbers. So the cap table is a way of communicating that. Lastly, I'll just mention that you'll come across the phrase customary in quite a lot of term sheets, customary terms for this or customary terms for that. Be very wary of the word customary because it could be hiding a whole bunch of things. So if you encounter the word customary, just maybe ask for a few more details because sometimes customary is not that customary. It's actually highly specific and can sometimes be a bit surprising. So always seek clarification of what is meant by customary when I talk about, for example, customary anti-dilution protection or customary liquidation preferences. There are no customary anti-dilution or liquidation preferences. Each one of those terms is usually crafted specifically for a deal, and particularly in a down cycle, customary can often mean much tougher terms than what customary meant in an upcycle. Okay, that's the end of my presentation. I've taken exactly 1 hour because we started at 5 past the scheduled start time. I'm happy to stay on for 10 minutes for questions if people have any. Otherwise, I'll let you get on with your day. It's not a large group, so if you've got a question, please just call out. It's easier for me that way.
Richard, can you explain, you mentioned that sort of tag along and drag along rights are they in conflict? Can you just unpack that a little bit more for me?
Yeah, they're not in conflict. What you mean, with each other or between the investors and the founders?
Yeah, or what the implications are. As a founder looking what's your preference in terms of a good result?
Okay, so take them each separately. So remember, the purpose of the tag along is to protect the minority shareholder from being left stranded in a business where effectively the people they'd invested in have deserted the business. That's the idea of a tag along. And the idea of a drag along is to protect the majority from an obstructive minority in the event of there being a good offer on the table that the majority would like to accept. And the offer being to buy the company as opposed to buy a smaller stake in the company. So usually the tag along is usually applied primarily to the founders because they are the shareholders that the investors care about the most. Because if the founders were to sell out, that's telling you a lot about the business, right? It's telling you that maybe the founders don't believe in it anymore, or they're less likely to work on the success of the business because they're reducing their stake, their commitment to the business. So the tag along is usually there to say, well, if the founders want to do that, then take us out too. So it means that, let's say you were a founder, let's say you had 60% of the equity in the business, which is not uncommon for a founder or a founder team, and you'd received a great offer for your shares, your personal shares, and you're tempted to sell, say, half your shares. Well, and let's just put numbers on that. Let's say half of your shares is worth $1 million, right? And what that means is that, well, you can, if the tag along right was in there, and if the board didn't stop you from doing this, but remember, you probably control the board, so this is within your gift. What that would mean is that, yes, you could sell your shares, but what's going to happen is that external buyer of those shares is going to buy the proportionate number of shares from all the other shareholders too. So if their budget was, say, $1 million to buy half of your shares, then they're going to have to spend that $1 million buying less than half of your shares and half of everyone else's shares.
Okay, that's clear. Thank you.
So it's really just designed there to make sure that it's fair. You can't leave your minority shareholders stranded in the business if you decide to leave the business or sell down. The drag along is different. The drag along is there. So tag along is really to protect the investors, right? The drag along can protect, depending on the situation, both the founders and the investors. So you can imagine the situation, right? The situation might be, as a founder in the very early days, you might have raised a chunk of money from a friend and family type investor, and you subsequently went on and raised rounds of money from angel groups, VC funds, and so on and so on. And you've been successful, and you've got this offer on the table to buy the company for $100 million, right? But your shareholders agreement might have a requirement that such a deal, sale of the company, requires 75% approval. And this early investor that you took money from, because they got you at a very early stage, their equity holding is quite substantial. They might have 30%, right? So they can block the deal. And they might block the deal for all sorts of reasons, commercial reasons, philosophical reasons, emotional reasons, all sorts of reasons, right? And without a drag along, there's nothing you can do about that. With the drag along, the 70% can force the 30% to sell into the deal on the same terms.
Great.
So
That's super clear.
that way you get your $100 million, right? Similarly, that same resistant shareholder could have been a founder, could have been a co-founder, right? Let's say you had a co-founder, you wanted to sell and they didn't. And let's say the numbers were the same. They were 30%, you were 30%, and the investors had the 40%. You and the investors have sufficient equity to force or overcome the whatever restrictions are on sale of the company because the drag along right is there. The key numbers with the drag along tag along, of course, is to determine the thresholds. What's the percentage threshold that's required for those terms to operate? So drag along will normally have a percentage between 50 and 75% as the required majority. And tag along will normally say something like either only applies to founder shares or applies to any proposed sale of shares that's more than 20% of total shares.
Okay, great.
The idea there is not to stop investors from trading shares with each other, which often happens, particularly if they've got like different investment vehicles, but to deal with strategic stakes.
Yep.
Does that make sense?
Yep, perfect.
Can I ask a curveball question?
So who's now speaking? I know that was Luke because I could see him. Is that Julie?
Julie, yeah. Sorry. Yeah, I've got a curveball question because I haven't done my friends and family round, but my investor's very angel-like. One of my friends is an angel-like in, not that they're professional investor either, but I see them having a strategic role with the business. So that's the question is, what's the boundary between an angel investor versus a friends and family round?
Well, all these definitions are a bit grey and overlapping. The key difference is that professional investors, of which Sydney Angels are an example, they don't know you personally. They don't have any relationship with you prior to meeting you for the first time. And they're not necessarily going to take things on trust. They'll want to verify, do due diligence and so forth, and probably negotiate with you to something that's reasonable. A friends and family investor will often invest because they trust you implicitly. They may or may not do any due diligence. They may just trust you and back you because they like you or know you as a person. That's the key difference usually. Not all times friends and family investors are as thorough as professional investors, but often do due diligence. They back you as a person, and often they come in on terms which are arguably too generous for the stage that you're at, but they want to do that because they want to support you. That's the key difference.
Have you ever made sure that your investments have the tax commissioner's ESIC compliance statements?
The ESIC compliance is just a rules-based exemption or tax deduction, which says that if a startup's less than a certain number of years old and meets other conditions, it is ESIC compliant. So a lot of investors do ask for that because it earns them a 20% tax rebate on their investment. So it's valuable to them. They can self-assess whether you're ESIC compliant. It's not hard to do. Some investors I've heard insist on getting proof because for some reason they can't self-assess based on the rules. As far as Sydney Angels is concerned, we can tell whether a company is ESIC compliant or not. It's not a requirement for us, but if it is the case, then obviously investors will want to take advantage of it. As a founder, you have to provide the information, and investors can self-assess based on the rules.
Okay, thank you.
I mean, if you're dealing with Julie, if you're dealing with an investor who says you've got to give me some kind of absolute proof that I'm ESIC compliant, that you're ESIC compliant, all you can do is say, well, here are the facts, here are the rules. Ipso facto, we're ESIC compliant. Investors should be able to assess for themselves.
Okay, so in terms of accountants and things like that, yeah, it's just clearly a simple self-administered process rather than a risk-free. Yeah, not well. I guess there's
problem.
Yeah, I think there is. Sorry about that.
Okay, one last question, then I've got to go. Okay, that sounds like a wrap. Everyone, thank you for coming. I hope you found the workshop informative. It was a bit of a one-way transmission. That just is the nature of the content of this particular workshop. We run other workshops for the general public, in addition to this one. Some of those are more interactive. Some of them are in person. So please, if you're interested, go along to those two. Thanks very much. Nice talking to you. Sorry, I don't know who you all are, and please keep Sydney Angels in mind if you're a founder with a good startup looking for that first professional round. Sydney Angels is typically investing in rounds of where the company's trying to raise between $200 and say $800,000. The average round is $750. Sydney Angels on average providing $200 to $400, but all these numbers have a range on them. Nearly every round we do has co-investors, so we're a good team player. Just keep us in mind. All the information is on the Sydney Angels company LinkedIn page, and you can apply anytime through our website.